Most financial advisors in Australia are honest, qualified professionals operating within a heavily regulated industry. This is not a video accusing the profession of dishonesty, but there are 6 specific things about how financial advice and superannuation actually work that rarely get explained proactively, simply because they're not required to be raised, unless a client specifically asks, or because explaining them in detail doesn't naturally come up in a standard advice conversation. Today, I'm walking through exactly what those 6 things are, why they're rarely volunteered without prompting, and the specific questions you can ask to get clear, direct answers, because understanding what to ask is often more valuable than any single piece of advice itself. Australia's financial advice industry underwent significant structural reform following the 2018 Royal Commission into banking and financial services, which led to major changes, including the removal of most commission-based remuneration on investment products, mandatory annual fee disclosure statements, and a legal best interests duty, requiring advisors to prioritize client outcomes. These reforms genuinely improved transparency across the industry. What they didn't do is eliminate every structural feature of how advice is delivered and charged that benefits from a client's lack of detailed questioning. The 6 things covered today aren't secrets or violations. They are details that exist in disclosure documents most clients never read in full, or nuances that require a specific question to surface, rather than appearing automatically in a standard advice conversation. Many financial advisors charge an ongoing advice fee, structured as a percentage of funds under advice, commonly between 0.5% and 1% annually. This fee structure is fully disclosed in the Statement of Advice and the Fee Disclosure Statement required by law, so it's not hidden. What rarely gets explained proactively is exactly how dramatically this fee scales, in dollar terms as your balance grows, often without the actual workload involved in managing your account, increasing proportionally. An advisor managing a $400,000 portfolio at 0.8% per year charges $3,200 annually. The same advisor managing an $800,000 portfolio for a client with broadly similar needs, same review frequency, same complexity, same reporting, charges $6,400 annually for what is frequently a near-identical amount of actual work. The specific question to ask is, as my balance grows, will the actual time and service I receive scale with the increase in fees, or would a flat dollar fee or capped percentage structure better reflect the work involved? Many advisors will switch to a flat fee or a capped percentage if asked directly, particularly for larger balances, but very few proactively offer this alternative unprompted, because the percentage structure is more profitable for the advisor. As balances grow, financial advice in Australia is regulated under a framework that distinguishes between general advice and personal advice, and within personal advice, between comprehensive advice covering your full financial situation, and scoped or limited advice, covering only specific topics the client has requested. The detail that's rarely explained clearly upfront is exactly which topics fall inside or outside the scope of a specific engagement, and Centrelink and aged care advice, in particular, are frequently treated as separate specializations that many financial advisors either don't cover in depth or refer out entirely, even within an engagement initially described to the client as comprehensive retirement planning. A client receiving advice on their super investment strategy and pension drawdown might reasonably assume their age pension entitlement and assets test position has been factored into the same advice, when in practice, some advisors provide only general commentary on Centrelink interactions, rather than the detailed modeling covered in our assets test video, because Centrelink advice specifically requires additional accreditation many advisors haven't obtained. The specific question to ask before any engagement begins is, does your advice specifically include detailed age pension and Centrelink assets test modeling, or is that outside the scope of what you're providing today? Getting this answer in writing before the engagement starts prevents a significant and common source of client disappointment. After the fact, following the Royal Commission reforms, vertical integration in financial advice, where an advice firm is owned by or receives benefits from the same institution that manufactures the super fund or investment products being recommended, has been significantly reduced, but hasn't disappeared entirely. Some advice practices remain affiliated with a specific dealer group that has an approved product list, and while advisors are legally required to act in the client's best interest, the practical reality is that an approved product list naturally narrows the range of options actively presented to a client, even when better performing or lower fee alternatives exist outside that list. This isn't necessarily dishonest. It's a structural feature of how many advice practices are licensed and operate, but it rarely gets explained proactively in terms a client can easily evaluate. The specific question to ask is the fund and investment option you're recommending on an approved list specific to your licensee? And if so, can you show me how it compares on fees and net performance against your super comparison tool results for similar options? This single question, asked directly, surfaces whether the recommendation reflects a genuinely open comparison or a narrower pre-approved menu, information that's technically available in disclosure documents, but rarely highlighted in the advice conversation itself. While most investment product commissions were banned following the Royal Commission, life insurance commissions, including insurance held inside superannuation, were not banned outright, only capped and gradually reduced. Under the life insurance framework reforms, in 2026, advisors can still receive upfront commissions of up to 60% of the first year's premium and ongoing trail commissions of up to 20% annually on life insurance, TPD, and income protection policies, including those held inside a client's super fund. This creates a structural incentive that rarely gets discussed explicitly. An advisor recommending a higher level of insurance coverage or recommending insurance be held inside super rather than a potentially cheaper standalone policy may be influenced by a commission structure that exists independently of what coverage level genuinely matches the client's actual financial obligations. This doesn't mean every insurance recommendation is commission-driven, rather than genuinely needs-based, but the financial incentive exists and is rarely volunteered as context for the recommendation itself. The specific question to ask is, are you receiving a commission on this insurance recommendation? And if so, what would the alternative fee-for-service cost look like instead? With a commission rebated to me, advisors operating under a fee-for-service model can typically rebate any commission received, but very few proactively offer this rebate. Without being asked directly, most ongoing advice arrangements include an annual review meeting, and clients frequently assume, reasonably, given the ongoing fee being charged, that their portfolio and super strategy are being actively monitored throughout between those reviews. In practice, for many standard advice arrangements, the actual ongoing monitoring between annual reviews is limited to automated systems flagging significant portfolio deviations, rather than an advisor actively tracking individual client circumstances, market conditions, or legislative changes specific to that client's situation. On an ongoing basis, this is not necessarily a failure of service. For a stable retiree with a straightforward super and pension structure, infrequent active monitoring between scheduled reviews may genuinely be appropriate. The issue is that the ongoing fee structure, charged as a percentage of funds under advice every single month or quarter, implicitly suggests a level of continuous, active management that doesn't always match the actual service delivery model. The specific question to ask is, outside of our scheduled annual review, what specifically triggers you to proactively contact me, and what doesn't happen automatically that I might assume is being monitored? Getting a clear, specific answer to this question, rather than a general reassurance, clarifies exactly what the ongoing fee is paying for. Between reviews, this is the detail most likely to cause genuine, costly harm, if not explicitly raised before any recommended change, and it's frequently not volunteered proactively, because it requires the advisor to actively check several specific details that don't always come up in a standard portfolio review conversation. Switching super funds can reset your lifetime health cover loading calculation. If linked life insurance restarts elsewhere, can trigger the loss of grandfathered insurance terms or premium rates that no longer exist in current products, can reset the clock on any existing binding death benefit nomination, requiring it to be resubmitted, and can in some cases affect access to legacy investment options no longer available to new members that may have genuinely favorable terms compared to current offerings. An advisor recommending a fund switch purely on the basis of better headline performance or lower ongoing fees may not always proactively check every one of these secondary factors, particularly if the client's existing arrangement predates the advisor's own involvement. The specific question to ask before agreeing to any fund switch is, have you specifically checked whether I have any grandfathered insurance terms, legacy investment options, or other arrangements tied to my current fund that wouldn't transfer to the new recommendation. This question prompts a specific check. That should happen as part of best interest advice, but isn't always volunteered as a standard part of the comparison presented. It's worth being explicit about what this video isn't saying. Good financial advice from a qualified, properly licensed advisor operating under the current best interests framework genuinely adds substantial value for the majority of Australians navigating the complexity. Covered across this entire video series: the age pension interaction, salary sacrifice optimization, withdrawal sequencing, and dozens of other decisions where professional guidance materially improves outcomes. The 6 things covered today aren't reasons to avoid advice. They are specific questions that transform a passive advice relationship, where you simply accept whatever's presented, into an active one, where you're asking the questions that surface the context most relevant to your own situation. Every advisor operating properly under current regulation should be able to answer all 6 questions directly, clearly, and without defensiveness, and an advisor who can't or won't answer them clearly is itself useful information about whether that relationship is serving your interests as well as it should be. 6 questions to ask your current advisor or any advisor you're considering engaging, structured directly from everything covered today. First, ask whether your fee structure scales proportionally with actual service delivered as your balance grows, or whether a flat or capped fee would better reflect the work involved. Second, confirm explicitly whether detailed Centrelink and age pension modeling is included in your engagement or sits outside its scope. Third, ask whether your recommended fund and investment options are drawn from an approved list specific to the advisor's licensee, and request a direct comparison against broader market alternatives. Fourth, ask explicitly whether any insurance recommendation involves a commission, and what a commission-rebated fee-for-service alternative would cost instead. Fifth, ask precisely what triggers proactive contact between your scheduled annual reviews and what isn't being actively monitored that you might have assumed was covered. Sixth, before agreeing to any recommended fund switch, ask whether grandfathered insurance terms, legacy investment options, or existing nominations have been specifically checked and accounted for in the comparison. None of the 6 things covered today are secrets, and none of them require an adversarial relationship with your financial advisor to address. They require 6 specific, direct questions, asked clearly, expecting clear answers, that move the conversation from a general discussion of recommendations to a detailed examination of exactly how those recommendations apply to your specific situation. The Australians who get the most value from financial advice aren't the ones who blindly trust every recommendation, and they are not the ones who distrust the entire profession either. They are the ones who understand the structural realities of how advice is delivered and charged in Australia, and who ask the questions that turn a standard advice relationship into one built on genuine, detailed transparency. If this gave you questions worth asking at your next review, subscribe and hit the notification bell. More straight-talking Australian finance content every week. Thanks for watching. I'll see you in the next one.